morning, everybody.
Morning.
Morning.
Everyone like that Dallas Cowboy game? No?
Trying game.
Huh?
What was the final?
No, they're not 4-1. But anyway. So good morning, guys. What we're gonna do today is we're gonna go through term. I'm gonna kind of fly through that. And then we're gonna also go through whole life. And I'm gonna go through how whole life as a product works, how it's built, how it's credited, how it compares to IUL, where and really when to use it, and more or less who to use it on or with. And then obviously throughout, if you guys have any questions at all, let me know. So when we're talking about term, just to kind of go through them as we started to do, and you guys have been on those Zooms every Thursday with the different product training. With Ohio's term product, I'm gonna go through Ohio's and then Mutual of Omaha, right? So Ohio's term, you've got 10, 15, and 20-year term. So you got 10, 15, and 20-year term where that is, again, you have level payment for that amount of time. And there's 3 different term products. You've got term basic, which is the cheaper end of the spectrum. So on the Yelp, call it restaurant review, just call it $1 sign. And then over here on the plus sign, or the plus side, it's gonna be a little bit more expensive because the plus term is gonna be fully convertible to any product, right? So on the basic term, it's only convertible to a universal life policy.
That's the
Not
basic?
yes, sir. Yep. Not an IUL. It's just a plain UL. So if the person wants conversion options, you're gonna go the plus route, which is personally, this is always good morning. This is always the direction that I'm going. But to save a few dollars, the term basic is gonna be the route to go. Term plus, right, is fully convertible within that time frame. So if they have a 10-year term, it's convertible for 8 years. If they have a 15-year term, it's convertible for 12 years. If they have a 20-year term, it's convertible for 15 years. And it's convertible to any permanent product on Ohio's portfolio. So whole life, IUL, UL. They get a 1-year conversion credit, right? So you guys all understand what that means? So basically, if they're paying $1,000 a year for the term policy, they'll get $1,000 conversion credit in the year that they go to convert to that, call it IUL or whole life. So if the new premium is gonna be $10,000 for the whole life of the IUL, that first year, once they convert it, that premium is gonna be how much? $9,000, okay? On a recap term is what? How many years?
5.
It's a 10-year term, but if they convert it within the first 5 years, 100% of the premium that they've paid for the term is used as a conversion credit. So as an example, if the person is paying in this policy $1,000 a year, after 5 years, they've paid a total of $5,000 premiums paid. If they go to convert it to an IUL or a whole life in that, call it 6th policy year, or in that 5th policy year, all of the premiums used in that time frame, or all the premiums paid within years 1, 2, 3, 4, 5 is used as a conversion credit. So if the new premium for the policy is gonna be $20,000, they've spent $5,000 on the term, you're gonna deduct, obviously, the $5,000. Their new premium payment for the IUL or whole life that year 1 is gonna be $15,000. The following year, it'll be 20, but that first year that they convert, it's a conversion credit. So they literally they basically had free insurance for that period of time, that 1, 2, 3, 4, 5 years. If they convert it in year 2, they get a 2-year conversion credit, 3-year conversion credit, 4-year conversion credit, 5-year conversion credit. If they don't convert it within the first 5 years, and they convert it year 6, 7, 8, 9, or 10, they're gonna only get a 1-year conversion credit. Okay? Most of the time, guys, this is really where you're gonna be spending most of your time. So you have convertible term policies, level payment for 10, 15, 20 year period of time. Any questions on this? And as I said, I'm going to kind of fly through that.
What happens if the conversion credit is more than, let's say, the first year premium? Is the rest of the money?
It's almost
put into a
impossible, right?
Policy?
It's impossible for you.
Yeah. It can't be more than, so reason is let's say they have a $1 million term, right? And they wanna convert half of that, and they were paying $1,000 a year for the term. The IUL or whole life, let's say, is gonna be, it's impossible for the conversion credit to be greater than the premium.
It's prorated too, so if they only convert half, they only get
Right.
half the credit.
Okay.
Right. Any other questions on just this Ohio term product?
Basic plus and recap.
Basic plus and recap. Basic is again, I don't wanna call it, it's non-convertible, but it's only converted
convertible
to
UL.
a UL.
Not IUL.
This is convertible to any permanent product, and this is fully convertible, but if the person is looking to convert within a short period of time, Ben, let's say he's a client, he starts a business, he's wanting to get the business up and running, but he likes the idea of a permanent policy. He says, Dustin, I like that idea, I'm gonna probably do it, or some of it, within a period of time. That would make sense for him to look at that product. Any other questions on this? It's pretty simple. Fine. Mutual of Omaha's term products, you've got what's called Term Life Answers and Term Life Express. We haven't really spent much time on this. I know we did the training, I think it was 2 weeks ago, they did a training, or 3 weeks ago. Term Life Answers is a fully underwritten policy. Let me back up for 1 second. On Ohio, right, regardless of the product type, what is the amount they can do fluidless? What is the insurance amount? So they can go up to $2 million, under what age?
45.
So 45 and under, they can go up to $2 million of insurance. So they could do, does it all have to be term? No, it could be $1 million term, $1 million whole life, $1 million term, 500 whole life, 500 IUL, whatever flavors they want. As long as they don't exceed the 3 scoops on the ice cream cone, they can do. I'm joking, but it's $2 million full face amount that they're eligible for. So 45 years of age and under. On Mutual of Omaha's Term Life Answers, it's the same concept of $2 million and below. I believe the age is, I want to say 50 or 55. I can confirm that for you guys. Both of these, of course, the company reserves the right to request a medical exam, right? So when you're doing the application or the e-application, you want to be pretty detailed in the application, and you got to complete over here and over there is the part B of the medical. Okay, here they do a phone interview. Here they don't do a phone interview. So when you're doing the e-application, as many of you guys have done it, they'll go through the medical questionnaire, right? They're asking, it's part B, who is your physician's name? When did you last see the physician, and what are you seeing the physician for? There's a bunch of medical questions. Do you take medication? Do you have any surgeries? Do you have diabetes? I can pull it up, but they have all those questions. Here they require us to complete that, and based on that information, plus what comes on the prescription check, the company, Ohio, is going to decide, do we require a medical exam or not? Here, you're going to submit the e-app, and they're going to do roughly, it's a half-hour phone interview with the client.
Always?
Yep, always. So they're going to ask that person, what is, and anything that you would ask on the application as the agent, they're going to ask it from the company's perspective. So you do up to 2 million, again, no medical exam. They have another and this is 10, 15, 20, and 30 year term policy. So they have a 30-year, they obviously don't have Ohio doesn't have a 30-year. So this is 10, 15, 20, and 30. Mutual of Omaha also has what's called the Term Life Express. This is a jet, I would call it a jet issue, or they call it a jet issue product. So this is something that if the person wants under $300,000 of insurance, you submit the e-application for the client, and on the spot, the company will approve or request for full underwriting. Right? It's not a guarantee issue, but it's pretty close. The difference here is the best class rating that they can get is a standard non-smoker or a standard smoker. So even if you've got a healthy superwoman, superman person applying, no medical issues, what have you, that's the highest rating that they can get, because it's basically it's not again a guarantee issue, but it's as close to it as you can get. Again, issued on the spot. Nadine, you did one of those, right?
Mhm.
It went pretty, I think it went pretty fast.
It did.
So,
And in what situation would you do that?
If you know they're a smoker.
if you know that if you know that they're, so here's, just so you guys can see, 18 to 50, they can get up to 300,000 on the Term Life Express. 25 to 250, so 25,000 to 250,000 from ages 51 to 60. And then ages 61 to 70, they're able to get up to $150,000 of insurance. Where do you do it? Where you know the person is not Superman, Superwoman, or somebody that's really just, I want to get it done and be done. They don't want to go through all this, you know, the hassle. And unless there's something massive going on, like with the person, they're gonna issue the policy. Massive, that I mean,
Yeah.
massive medical issues that come up in the background.
You also may have a client that doesn't want the nurse to come out, or
Right.
like needles and that
Yeah.
type of thing, that's willing to sacrifice a couple rating points.
Yeah, I mean, and you have a client that wants 100 or whatever the number is. It's just a very quick way to get it done. They also, over here on the Term Life Express, they have a 30-year term with return of premium. So you have, let's say, a younger client, they want a 30-year term policy, but they want their money back if they don't die within that time frame. They have that as well on this side, meaning on the Term Life Express product. Any questions?
The simplified underwriting for mutual home loss, it's also under 45, right? Or it's 50?
It's, I gotta get the exact age. I don't know offhand, I'll get it to you.
The return of premium is only available on Term Life Express.
Yeah. Yep, so when you get appointed with them through us, and you go on their website, you'll see this is like the marketing guide, and it has over here like Term Life Answers. There's no, return of premium, and then it'll have over here Term Life Express, and then it'll have again, ROP, return of premium. Return of premium is more money than just a plain term. So they're paying a premium on that product. Any questions on this? I'll get you guys the fluid list age. No questions on this? Alright, so guys, I'm gonna erase, can I erase this? Ow. Should get that on camera?
No.
Not you. Good? Okay?
Yeah, good.
Alright guys, so what I'm gonna go through now is whole life, right? So just, you know,
Justin, I'm sorry. before you get-
yes sir.
Are any of the mutual loan convertible?
Yes, fully convertible.
Fully convertible.
Yep, all of them. On, let me just go through here. So, on whole life compared to IUL, right? Before we go into specifics on whole life, what are some of the differences compared, again, from IUL to whole life?
Flexibility.
In what capacity?
You're able to raise and lower premium. You're able to raise and lower death benefit.
So flexibility is one of the biggest, if not the biggest differentiator for these two products. With IUL, to Ben's point, it is flexible in payment. You've got a minimum and you have a maximum, and every year they can increase or decrease how much they're putting into that policy based on what their goals and wants are. In a whole life, it's what?
Fixed.
It's fixed. What you see, and guys, what we're talking about here, by the way, is not company or specific. This is just how the car works across all of the insurance lands, and doesn't matter carrier. So whole life premium is gonna be fixed across the board. What you see is what you get, and they've gotta make those payments in those policies. Now, one of you is probably gonna say or think that, well, Dustin, if there's cash value in the policy, don't they have the ability to take cash out and pay the premium? Yes, they do, but really in the beginning, I would say for the first 3, maybe 5 years, you've gotta make the payment in that policy. I'll give you an example. We had a client, a local business owner, owned a body shop. And one of his things that he had was he had a whole life paid up at 65. And he was putting in about $500 a month or $750 a month into this. He was using it as a supplemental retirement plan. In year 1 of him having the policy, one of his mechanics forgot to put the car in park, and the thing basically, the car fell off of the what do you call that thing? The lift or the track. And he had there was a lawsuit. So he had to save and wanted to save some money. In year 1 of this policy, could he do that? No. The $750 that he was putting in, or $5, he had to put in. Here, could he have made a reduction in premium payment? Yes. So that's an example of one of the areas. On the flip side, the benefit of this over this is you have an end date of payment. If you're doing a 10 pay, a 20 pay, or a pay to 65 whole life. Okay? We'll just do a 10 pay, let me do it this way. 10 pay, 65, or pay to age 100. So if a person does a 10 pay whole life or a pay to 65, contractually, if I have a 10 pay, how long am I paying premiums? 10 years. If I have a pay to 65, how long am I paying premiums? Until age 65. On an IUL, can I stop making payments after 10 years? Yeah. Am I contractually guaranteed that will happen in real life? No. So always on an IUL, premiums are always due from someone or somewhere. It's either coming from the client's bank account or it's coming from the cash value. Either one of the two. In a whole life, after paying for 10 years, if I have a 10 pay, or if I have a pay to 65, once that time frame has come, passed, there's no premium coming out of the policy. Good? Okay. Cash value, right? And we're gonna go into how this works. So cash value on an IUL, how does that work?
Grows from an index.
It's gonna mirror an index and how it performs every single year. It's gonna be S&P 500, Russell, MSCI, or there's also a fixed account. And every year, a person can shift where their money is invested, right? On S&P 500, you have a capped strategy and you have an uncapped strategy. Can they put 50% here and 50% here? Yes. Could they put 100% here? Yes. Could they put 100% on a fixed account? They can mix it up every year, whichever way that they want. Here, in a whole life, how is cash value credited? So it's based on dividends, which is what?
From the company profit or something?
Right, so it's gonna be, dividends are calculated based on the company's profit. And the biggest thing that it's credited on is what? This is again, guys, across the board. Fixed interest. It's based on on fixed interest rates or the 10-year US Treasury. So let me find it. So guys, across the board with whole life carriers, doesn't matter who they are, the interest or the cash value is credited based on a fixed return, but the biggest piece of it is based on dividends, which is built by the company's profit and loss, as well as the biggest component is 10-year US Treasury. So this is historically, these are the historical dividend rates since 1988 from Ohio, Mass, Northwestern, and New York Life. And this is going till 2020. I didn't have them send an updated chart, but this is giving the actual historical dividend payments from each of the carriers. And you'll notice in the 80s, right, what their dividends were. So is that pretty good or bad?
It's good.
It's pretty good. At that time frame, what were interest rates? Here's the year.
Remember, but it went 15, 17.
So at that time frame, if you guys ever want to show this to a client or you want to look for yourself, and you go to, this is just type in historical, 10-year historical, US Treasury rates, this is what will come up. And you can go to any chart, right, and if you look over here at the height, you've got in 15.41% in September of 1981. And then you have over here that it goes down, it's still at 13%, and then it goes down to 10%, it pops back up to 13, and then starts going down, 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 down. So basically in the 80s, you had, if you went to get a loan from a bank, Bank of America or whatever bank, to buy a car or buy a home, you were paying a lot of money for that money, right? You were paying 10, 12, 13, 14% interest for every dollar that you borrowed from the bank. In the same token, if you went to park money at the bank in money market CDs or something like that, guess what you were credited? Somewhere in that range, right? And then over time, as we could see, guys, right, the interest rates have declined. And over the last, really up until January of this year, money to borrow from a bank was virtually free. You guys all, so people that would buy homes, they can get a bigger home because they paid less for the money. Construction companies or developers that wanted to remodel or redo and build were doing a lot of that because the money is virtually free, right? And now what you have, if you look at the historical dividends over the last six plus years across the board with every carrier on dividend payments, is it high or low?
Low.
It's low. The actual dividend returns on whole life policies across the board have been low. Why? Because there's been low interest rates. Now with any carrier, Ohio National, Mass Mutual, Penn Mutual, New York Life, it doesn't matter the company, when you show a whole life illustration, the illustrated rate is the current dividend rate that they're able to show. So if I bought a policy or somebody bought a policy in the 80s from a rep, from an agent, right? You have, Mary Smith is an agent, she's sitting down with John and Mary is showing John, here's this great whole life policy from Mass, from Northwestern, from Ohio, whatever it is. Guess what their illustrative dividend rates were at that time frame? Here, so if I ran an illustration for any of these companies, the assumed dividend rate were those numbers, whatever those numbers were in that year.
For the life of the policy.
For the life of the policy, year over year. So as a client looking at that, does that look pretty damn good or pretty bad? It's gonna look pretty sexy, right? If they purchased that policy, paid into it over the last 30 plus years, and they looked at their original illustration compared to what they have in real life, are they happy or sad? If they're comparing the two, they're gonna be upset because the dividend that they received compared to what was assumed wasn't in real life. Today, guess what you have?
Opposite.
Is the opposite. Now, when you're gonna run an illustration on a whole life product, you have to be able to, if you're gonna show it, you're gonna have to be able to explain to the client, look, I'm showing you a dividend rate of 4%. Why? Because money was virtually free over the last 5, 6, 7 years. It's based on, yes, the profitability of the company, but the biggest thing it's based off of is the 10-year US Treasury, right? Fixed rates. So now if I'm showing somebody, or you're showing somebody a whole life illustration, and you're showing an illustration at a 4% illustrated rate, or Lafayette that has a 5.75% illustrated rate, it doesn't really matter, it's really within the same ballpark as you guys can see with all these companies. If the client doesn't think and doesn't understand high level how it works, right? They're gonna look at their money in and then the cash value and look like, not that good. Compared to if I show them an IUL from any company, compared to a whole life, they're gonna be like, what? I'm gonna pick an IUL over a whole life because it looks better. And it may be better, it may be worse, it just depends on the scenario. But as an example, what I wanted to explain to you guys and share with you is here are the historical dividend rates from all of these companies. You can see within a tenth of a percent, they're all over the course of however many years that is, 33 years, it's virtually the same number. It's virtually the same number, and why that is because over here, what insurance companies have to do is they have to park a boatload of money in reserves and put it into this investment strategy, which if this is only paying this, what could they pay? That or lower than that, right? But if this is gonna be paying 9, 10%, what could they pay? More, because their money is making more money. So they're actually, insurance companies are required to park a boatload of money in cash, in fixed accounts, and they can't leverage it over a certain amount within that. That's the whole thing behind that. Before I go into showing you guys illustrations and where and why and how, any questions with any of that? How it works, where it works, what I just said, if it makes sense? No? Okay. Okay, so what I ran for you guys was, well, before we go there, okay. So with Ohio, and I'm not gonna show Lafayette, I could show it as an example, but Ohio has a 10-pay, so it's the IWL, and it's a 10-pay index whole life. They have a pay to 65, and they have a pay to 100. A pay to 100 is just, client is 40, contractually they have to pay premiums until age 100. If they have a pay to 65, contractually client has to, or they're done paying at age 65. And if they have the 10-pay IWL, or just a regular 10-pay, it's done after 10 years. Good else, you got 10, 65, 100. I ran for you guys so you can see, and we can run some live as well. But where these make sense is where the person just wants to be done, right? After a period of time, they just want to be done with contractually paying premiums. This is where it really would make sense. So have you guys looked at this, the IWL illustration? You guys have? So when you're running it, or this is what the illustration would look like. I like this little chart. It shows, premiums coming in, account value, cost of insurance, loans or anything like that, and then interest is gonna be, again, equity from the index or a fixed account. So I like this little graph that shows, I'm a visual person, what that looks like. It'll show here, they're credited the 15th of the month. And then this chart, if you guys could see this, and this is gonna be on page 7 of every IWL, it will show the actual historical returns of each of those indexes. So on an S&P 500 capped strategy, if they had this, and it ended again, December of 2021, the index grew by 27%, they made 9. If they wanted to go with the uncapped S&P 500 strategy, index grew by the same 27%, they actually made 18 because of that spread, right? Here you'll see index lost money. Do they ever lose money? No. So it's kind of blending a whole life with an IUL, and you contractually are done paying premiums after 10 years. And then obviously this is the euro, and then this is the Russell. So that's a good graph to show. Obviously I shared with you guys on the IUL where to show the historical returns. This is showing it live on the illustration itself. Any questions on that, or? No? So, over here on page 13, you'll have, if they have a terminal or a chronic illness, they can accelerate, part of that cash value or that death benefit for care. And then just like in an IUL, you're gonna have a guaranteed return, you're gonna have assumed return, which is assumed is gonna be 2.5%, and then you're gonna have on the current scale, which we're gonna illustrate, 100% of the money is S&P 500, and essentially it doesn't matter which strategy, we're assuming that it returns 5.6%. So it really doesn't matter the strategy other than the fact that we're showing that it's doing 5.6%. If they picked a different strategy and it did 5.6%, would it still return these numbers? The answer is gonna be yes, right? So over here, what I ran for you guys is a client that has a 10-pay IWL. They're putting in $20,000 a year for 10 years, and then they're contractually done, right? So after, this is a 40-year-old done at age 50, he has $209,000 of cash, $397,000 of death benefit. And if the market or index performs greater, will he have a higher return? Yeah, right? If it returns less, will he have less? Yes. And if you want to show what is the guaranteed, this is if it does absolutely nothing, on a guaranteed basis, this is what you got. You put in 200, you've got 172 there. Okay? So this is going to be more on the conservative side as far as what the illustration is going to show. But what I showed was, let's say you have this, this 40-year-old that has a newborn baby, and he or she wants to do something not only for retirement, but also for college. So in 18 years, right, that newborn is getting ready for college, and we're illustrating that he's pulling out $20,000 a year for 4 years, tax-free, to send the kid to school. Now he could actually pull out a lot more, right? There was $216,000 of cash value. We only had him pulling out $80,000. But I pulled out $20,000 a year for 4 years, stopped pulling money out, there's no more premiums due, and then what I illustrated was that when the client turns 71, he's pulling out $50,000 a year for 10 years for retirement purposes. Oh wait, what am I doing here? You guys didn't stop me. Sorry, he has, by age 18, I was showing you on the guaranteed side. On the current scale, he has $307,000 of cash. Yeah, $307,000 of cash, and we're only pulling out $20,000 a year tax-free for the kid's college. At age 70, he's then pulling out $50,000 a year for 10 years to supplement retirement. So he pulled out how much over the course of 14 years of withdrawal? It's 580 grand. He put in 200, and he pulled out 580,000 tax-free, as well as creditor protected as well, and also protected from any market loss whatsoever.
And still has a death benefit.
And still has a death benefit at age 82 of 354,000 and a cash value of 155,000. I just wanted to show you guys something clean that was 20,000 a year for college and 50,000 a year from age 70 till age 80. Could they take out money from age 65 till age 85? Yes. Would it be less? Yes. Could they take out more from that period of time? The answer is yes. Again, I'm just showing you an example that somebody's not killing kind of two birds with one stone in this type of strategy.
Can we also set this one up like a pension?
Yeah, like I was showing here.
Yeah, but just pay indefinitely?
Yeah. Yep. you could run it, I can run it, or you can run it with any which way. I was just showing where your person's doing it for college, plus they're gonna do it to supplement their retirement assets. Frank, you had a question? No? So one of the differences though, guys, with whole life compared to IUL, on an IUL, you have premium flexibility early on, right? So here, if he was putting in this case it's a he's putting in $20,000 a year, can he pay less? Yes. Here, can he pay less? No, he would have to reduce the death benefit if he wanted to pay less. Then you have to completely reconfigure the policy, which is not what anybody wants to do. The other difference between a whole life and an IUL is early on, there's a benefit of this over this. What's the benefit here early on in a whole life versus an IUL?
Pay and you're done.
Pay and you're done. But what's early on in year 1, 2, let's say year 2, year 3, year 4, year 5? Where do I have a benefit here over here?
Cash value?
Yes, but specific to what?
Specific to what?
You're right, there's a difference there's a benefit here in the cash value early on over this one, but where specifically in the cash value?
Cost of insurance?
You have accessibility to any cash that's here in a whole life. You have accessibility to all of it. In any IUL, you have accessibility to a percentage of it. Let me show you guys. So this is just a 40-year-old male putting in almost $15,000 a year into an IUL. Over here, this is an IUL, right? Over here, he's putting in $14,000. He has an account value of 12. What can he touch? 1220. In any IUL, I don't care, Mutual of Omaha, Lincoln, Ohio, doesn't matter the company, in an IUL or in a VUL, the client can only withdraw or take a loan off of the cash surrender value, not off of the account value. After how many years does a person on Ohio's IUL have full accessibility to 100% of their account value?
13.
Year 13. So year 13, client has 231, he can take 231. In a whole life, with any company, whatever is in cash, they can do what? They can touch all of it. So that's also another differentiator between here and here. Again, here you've got more flexibility with premiums going up, going down from day one. Here you don't. Here you have access to cash if it's available, if it's in there, year 1, year 2. Here you do, but it's a fraction of the policy.
Is it always year 13?
In Ohio's, yes. Some other companies it's year 15. It just depends on the carrier. It's a surrender. It's a declining surrender penalty.
Okay, so when clients ask me when they break even, it's always, the answer's always 13?
Yep, always 13. On Ohio's. Always 13.
But break even isn't the right
No.
answer.
Well,
Oh, is that what you said?
He said,
Yeah, no,
when a
I-
client asks me when they
I
break
phrased
even.
I phrased it wrong. Not break even, you know what I mean? Where the account value matches the cash value. I always go and look at
I mean, right here, right? In this on that one, you're not gonna have a year. On an IUL, you will not, you can say to a client on every IUL with Ohio, that you have 100% accessibility to every dollar of cash in year 13. For what you're asking, there's no break-even point across the board because it depends on,
No, yeah,
The
I
face amount, the
misspoke, I meant when the account value matches the cash ended.
year 13.
Yeah, okay.
What questions do you have in regards to the whole life, where it works, where it's used?
So you can take all of the cash out of the whole life, not, let's say 90% without surrendering the policy?
Yeah, I mean, yes, you're right. In any, if somebody has a policy and they want it to be active, they don't wanna take 100% of the cash value out. They wanna take 80-90% of it out. But my point was just on an IUL, the only thing they have access to at the end of year one is 1220, even though they have almost 13,000 of cash.
Right.
Here, year two, they have 25,000 of cash, but they have access to 14,000. In the whole life, they have access to 24,000. They have access to year three, 42,000, 63,000, so on and so forth. Now, to your point, do they wanna take all of that? No, they should probably take, like you said, 80-90% of that, if needed.
The illustrations that you're showing, the one that you showed with the retirement,
This one?
the IWL. Does this illustration take into account the interest rate they're paying on the first 80,000 they took out for the college?
Yes.
And it still performs at that level?
Yeah.
But it's showing today's loan
Dividend.
rate?
Correct. Right. And any illustration is gonna take into account withdraw, loans. It will always take into account the loans. And I'm not ever having the client pay the loan back.
Justin, can you explain the difference between the types of loans?
Well, there's the index loan and then there's a surrender loan, right?
Yeah, so there's
Different percentages on each.
right, the standard loan is gonna be basically 4% to 4.4, it's 4 or 4.4%, and an indexed loan, it's gonna be a variable rate based on what interest rates are in that year. And if the cash value performs higher than what they're charging for the loan, there might be a positive arbitrage on the money.
Do both loans affect how the allocations are credited the same way?
Yes.
Ask that question again.
Do both types of loans affect the way you're credited for the various allocations? In other words, in a whole life, you take a loan.
The whole life performs
Right, you're still
as if
credited
you
for
did.
the full amount.
Correct.
On an
Yeah.
IUL, that's isn't necessarily true, right?
Yeah, they're getting interest as if they didn't take money out.
On both policies.
Correct.
On both types of loans.
Correct.
Okay.
They're not taxed on this money, right? So again, guys, the big thing is that it's, in the state of Florida, it's creditor protected. And also, they're not, across the board, they're not taxed on any of that money that they're pulling out. And also, when somebody's going to do, apply for college, the student has to put, when they complete the FAFSA form, they have to put how much they have in assets, which, what does an 18-year-old or 19-year-old have in assets? Not much unless they inherited. But the parents also have to note on that FAFSA form what they have in assets. And 529 plans will count against that student for financial aid and grants and things like that. Here, cash value doesn't count against them. They don't count it, right? And you guys all understand that when somebody pulls this money out, whether it's used for the kids' college or for their retirement, they're not declaring that on their taxes. So it also impacts positively the other money that they're withdrawing to live their life.
So you can use these policies as a shelter against colleges that are looking to find more money from you, or
Right.
nursing homes that are looking to find more money
Correct.
from you.
Correct. Because you're not putting it on any application, and you're not declaring it as any type of income to Uncle Sam when you're pulling the money out.
Cause it's not an investment, it's a life insurance policy.
Now, when you guys run these illustrations, I mean, if you don't know how to do it, obviously let us know. I also, I've said a bunch of times, is sell through stories, or, paint pictures for people, or give them a concept, an idea of what is out there. This is, you can go into, whether the client is 39, 38, 40, 41, 42, whether they have a budget for 20,000, 18,000. Conceptually, if you can show that to a client without having to run their own illustration on a first meeting, that's how you really get them to open up. Does that make, you know what I'm saying? I always use the example of, remodeling a kitchen. And somebody, a general contractor, not showing a visual on their iPad and just saying, Frank, what do you want the design to look like? Or Nadine, what do you want the design to look like? The clients or customers may not know what kitchen they want to, model to look like. But that general contractor that sits down and says, oh, let's have a cup of coffee, and I say to Nadine, look, let me show you some designs of kitchens that I've remodeled, just to kind of get the juices going. It helps spark and start the conversation. I always like to show examples of things that we're doing for others, and it's also taking the point off of the person of selling them, and it's opening up the conversation for dialogue. So besides the what, I'm kind of giving you guys some collateral, at least what I use to open up the conversation, and you can always build it for them. So over here, when you're running these illustrations, right, so the product type, if you're doing the index whole life, over here is where you're gonna pick the allocation. Now remember, I always show the 5.6% rate. The average S&P 500 over the last 50 years has been 10.4%. That's what the average S&P 500 return has been. Just because you show 100% here, just to again restate the point, does that mean that's what the client has to do? No, right? They can reallocate or juggle where their cash value is credited. Over here, you're putting in, again, the person's age. And then over here, you're solving for either the face amount, or you're solving for the amount they're wanting to spend every month or every year, and the system will give you the numbers back. Make sense? So it's calculate face amount based on plan premium. The premium mode over here, are they paying monthly or annually? And then over here is where you're entering the loan amounts. I inputted those manually. You could also, to Rachel's point, is I could solve for maximum loan, and I could say I want to have a cash value target of $1,000 by the client's 100th birthday, and they want to start pulling money out from age 72 through, let's say, age 92. And the policy is running. They're taking out income for 20 years of almost $53,000, tax-free. When you guys are running illustrations, whether it be IUL or whole life, if they're funding it, to me, you guys have to show income. I think if you don't show income and you just show, if you show me, okay, Dustin, you put in 200 grand, you have 210,000 of cash, like,
Why is that exciting?
It's boring, right? Yes, that's 10 years, but even so, in 20 years, I put in 200,000, I have 367,000 of cash. It's good, it's not phenomenal, right? Where it really, again, sings is that income piece, or whether I showed it the 20,000 a year coming out for college and then 50,000, or you just do a flat pension like Rachel is saying. When you're showing income that way, that's where it really, I think, benefits a client visually and in all reality, because what that, let me show you what I mean. And what I run, as you guys know, is I use the time value of money. So if I have a 40-year-old putting in $20,000, making 5.65%, right? In 10 years, they'll have 273. As an example, if you compared this, they'll have 660,000 of value if they put it into an investment structure that performed at 5.65%. Meaning, I put in $20,000. After 10 years, I have 273 of cash, right? In any investment. I never add to that, whoops, that's not true. I never add to, that's still not true.
What was the other number? It was
It'll be true, somewhat true. They'll have 491 of cash in an account. Does that make sense? So they basically take $20,000 a year, let's say they're in a 25% tax bracket, they fund it for 10 years, at the end of 10 years they're gonna have 253,000 of cash. They never add to it again, it does the same 5.65%, they're still in a 25% tax bracket. At age, let's say 70, they have $605,000 of value, whether it's E-Trade, Scottrade, Ameritrade, whatever. If they go to take income from that, what's the amount that they should take? 4%, right? So you take 4% of that $600,000. That's $25,000 a year. Whoops. That's $25,000 a year.
That they have to pay tax on.
And they have to declare as income when they're doing their taxes. Over here, on a very, very, very conservative basis, they're pulling out twice as much tax-free and not reportable, which again impacts the rest of their money in a very different way. Do you guys know how to figure out the pre-tax equivalent to get to that number, to net that number? Does that make sense?
Yeah, can you show?
What number does the client need to pull out of a 401k?
To be equivalent to the 50.
Huh?
To be equivalent to the 50,000 whole.
Right.
No.
At what tax rate of 25?
Yeah. All you do is you take this income, times it by 100. So you take 50,000 times 100. You have 5 million divided by 75, because I'm at a 25% tax rate. Whoops.
It's 67,000.
So they need to, if they had a 401k, and they withdrew $67,000 a year, and they were at a 25% tax bracket, they would net $50,000. Does that make sense? If they're at a 39% tax bracket, you take the same 50 times 100 divided by 61, they have to withdraw 81,967 if they're at a 39% tax rate. To net, to net 50. Now, if I have to pull out $82,000 from a vehicle and the withdrawal rate is 4%, what number do I have to have an account to withdraw that?
Over 2 million.
I have to have over $2 million to withdraw and get $82,000 a year.
And you need to maintain a rate of return that keeps you over 2 million.
Right. Does that make sense, guys? To me, when you show people, clients, just the math on certain things, I mean, if they don't have the want or the budget or the financial wherewithal to fund any type of account for the future, obviously nix this whole conversation and just show them term and let's say have a nice day. If they're looking for additional or alternative ways to fund different things, right, is this the only thing they should fund? No. But can they carve this off as a piece of the pie or the puzzle? Absolutely. Does that make sense, or anyone confused? Ben, you got that?
Yeah.
Sure.
100%.
Mike, you good? You from?
Yeah.
That's, so basically, all you're doing is you take the net income they're receiving, times it by 100, and then you divide it by the net rate. Is that the right way to say that?
Net rate of return.
Not net rate of return. If they're at a 39% tax bracket,
It's the percentage they're gonna keep, not the percentage
it's
they
a
pay.
percentage that they're gonna keep from paying Uncle Sam. So if they're at a 20% tax bracket, you take 100 less 20 is 80. You would divide this by 80. Right?
Yeah.
Is there a shorter way to do it?
No, it's that cut.
Right.
They're cut. Government gets big, you get what's left over.
The big.
Any questions on these illustrations, how to run it? When you guys are running income, so as I said, when you're showing it this way, and you explain it to me that way, it's powerful. It's really, really powerful, regardless of carrier, regardless of product. It's a powerful, powerful, powerful thing. When you're showing income, when you're showing it and you want to solve for maximum loan, if you show it this way every time, you're telling the system, I want a cash value target of $1,000. So you're saying, system, I want $1,000 in cash by specify age, by age 100, and I want to take income from my 72nd birthday to my 92nd birthday, or I want to take income from 65 to 84, whatever age you want to take income, you can put that in there. But the key is that this is 1,000 and this is age 100.
On the Ohio policies, is there a limit on how many withdrawals they can make a year?
Not that I'm aware of. Not that I'm aware of. Why? Where did that? Where is there? Somebody asked that question?
No, I'm just thinking, we're showing 52,000 a year, but they don't even have to take that, they don't even need to take what they need. It's not like a report.
Well, it's worth mentioning too, on all these illustrations, these numbers are all arbitrary. It's
Right.
all conceptual. Once you place the policy, anything that you want to happen has to be done. It's not gonna automatically be set in place just because you
Yeah, I think that's
provided
maybe
an illustration.
Yeah.
Because they might see that and assume that the policy's being drafted that way.
Right, and if they wanna use it as a volatility buffer, right, the volatility buffer is any year that there's a down market year when you go to retire, that's when you take money out of your IUL or your whole life and let your market money revive. So that money, that cash is gonna simmer in the IUL the whole life until there's a down market year, and in that year, then you take out the 50, 60, 70,000 or whatever that number is. But I think, guys, it's really, really important to mention, and I keep saying it, is the income and from these policies, because people have been programmed for a really long time in I don't wanna say the wrong way, but years ago, we all, know people retired with a pension plan. Anybody that works for the public sector, after they do their 25, 30 years with the department, City of Fort Lauderdale Police Department, or whatever area or municipality they're working for, they retire with a set income for life. Companies, as I've mentioned a bunch of times, years ago, offered pensions, right? IBM had a pension. AT&T had a pension. Motorola had a pension.
Chrysler.
What'd you say?
Chrysler.
All these companies have, most big companies that all of the companies that we know the names of, household names, had pensions. And in the early 2000s, the companies shut pensions off. And what did they do? 401. They shifted to a 401k. So if somebody worked at Ford or whatever they call, or Motorola, from 1990 to 2000 and let's say 5, I don't know the exact year that they shut it off, but let's say till 2005, they worked for the company for 15 years and they had a pension, and they will get a pension if they retire and they fulfill their service, right? So let's say it's 2005, client is, 45, or let's say, yeah, they're 45 years of age. They started at Chrysler when they were 30. They're still working at Chrysler or Motorola. Chrysler says no more pension. They're gonna do a 401k. So now that person, as long as they put in, let's say 3% of their income, Chrysler or Ford or whoever it is will match them 3% of their income. So when people did benefits, they're now enrolling and they're doing, okay, I'm gonna match, I'm gonna do my enrollment in my 401k, and they've built up these buckets of 401k nest eggs. They retire, right? Today, we're seeing a lot of times at age 72, what does the person have to do?
Go back to work.
They've got what?
Requirement.
They have to take required minimum distributions from their account. And it's roughly 4% of the value. And if not, they're penalized 50% of what needed to be taken out. Not by me, but by Uncle Sam. So there's this, I would say, shift of where people are wanting to put money because of they want to pay Uncle Sam less and keep more, not only for themselves, but also their family. You guys realize, right? So if somebody has, for every $1 million that somebody has in a 401k, that they should take out no more than what per year? What's their withdrawal rate? 4%, right? So 4% is the safe withdrawal rate, or $40,000 per year. The real actual number changed is actually 2.8%. We're not gonna go with that because it's really low. But people are living longer. I heard somebody say the other day that the first person to live past 200 has been born.
I heard something.
Wow.
No, it's just a saying. It's like
It's true.
Yeah, I know you're saying.
like
I
30
don't know,
years
if
ago. they said
you
the
ask your parents, right? Did they think, or do they believe that they would live to 100, or that many people would live to 100?
Yeah, I mean, 200 is definitely not gonna happen, but I know what you're
I
saying.
think that's it, I think that's inaccurate.
It's not possible.
Dustin's gonna be the one to do that.
No, I don't,
This
I
is
don't.
gonna be like 201 was deathbed, like I told him.
I mean,
No,
we'll all be
it's-
dead, but
Speak for yourself.
It's, the point is, people are living longer, right? People are living longer, and people are working till they're older. But my point is if I have $1 million in a 401k, for every 1 million I have in a 401k, I can withdraw 40,000 a year. Can I withdraw more? Yes. Am I gonna run a risk of running out of money? Yes. In addition to this, when I die, my wife gets that money, or if she has a 401k, when she dies, I get that money. When we're both dead, what happens?
so the kids,
Goes
the
under
estate.
the IRA.
Our kids inherit the IRA or the 401k, and what happens? What does Uncle Sam say?
They have to
10
tax
years
it.
to liquidate it.
You have 10 years, kids, or whoever the heck is inheriting the money. A non-spouse inherits the money. So as long as it's a non-spouse inheriting the money, those individuals have 10 years to make that a zero. So for every $1 million they inherit, they've got to withdraw a little bit more, but let's say $100,000 per year. And what if they withdraw that 100,000? What do they have to do?
Taxes.
They have to pay tax at whose rate? Their ordinary income tax rate in that year. And most people that, let's say, inherit that sort of money from a parent are gonna be in their 60s, right? Give or take. Maybe 50s, obviously life happens, but statistically, if people have kids between 25 and let's say 30, 35, parents are dying at 85 years of age, some a little bit older.
200.
They're 200. There you go. They're paying tax in addition to what their income is. So if that household is bringing in 300,000 a year, they actually bringing in now 400 or 200. If they make 200, they're bringing in 300, whatever the number is. And this is just for $1 million, guys. A lot of people have a lot more. The client that he did the 1035 on, spouse, the guy's a doctor, his wife passed away, he's not remarried or anything like that to our knowledge, and he has 1.8 million-ish now, I don't know what the value is, but call it $2 million in pre-tax money that the guy is gonna work for another 2 years. He's gonna fund his retirement account for another 2 years from his earnings, plus guess what the money should do? Grow. And it should perform better than it's performed over the last 6-7 months because the market's been down. So that $2 million is probably gonna be, I don't know, 2.6 million or whatever. So when he dies, if he doesn't remarry, those kids are gonna inherit money, which is great, but at least for me, when people say, my kids or whatever they say, my spouse, I don't want, those ridiculous comments people make. My point is if I worked hard to build my nest egg, the people I want to enjoy it is my family, not Uncle Sam. That's my philosophy, and that's kind of the trend that you want to get them to shift to. So my point is if they're shifting some of their investment, if you will, or contribution into retirement into these strategies, there's also a tax-free death benefit that's paid when they die. In addition to accessibility of the cash throughout the length of the policy. So I'm just kind of giving you guys little nuggets here or there. Any questions on anything? We just went through here on the 10 pay, right? But you can also obviously look at, this is the regular 100, and then the Prestige Max 4 is gonna be paid up at 65. So Prestige Max 4 as an example, person's 40, he wants to put in 20 grand a year annually, he's funding $20,000 a year until age 65, guaranteed, right? And then he's pulling out say he does it for 10 years, 63,000 a year for 10 years.
What's the protected?
It's just a 100 prestige one. The premiums are paid through age 100 versus 65, age 65
So
or
it just makes it cheaper?
exactly.
But it also makes it grow at a different rate.
Grab it, yeah. But that's actually
What was the name of
really
this one
useful.
again? Prestige?
This one?
Yeah, it's the,
This one is
Five.
paid, is Prestige Max
Max
4,
okay, thanks.
but it's
Yeah.
paid up at 65. And then the Prestige Protector is just paid to 100, which is less expensive, and obviously requires less premium and grows a little bit at a lower rate because there's less premium. What questions? We got 10-ish minutes. None? So we went through the terms with both carriers, we went through the Express with Mutual of Omaha, we went through Whole Life, how it credits dividends and interest, right? It's based pretty heavily on 10-year US Treasury, which if you're showing a whole life, like if you're showing as an example this illustration that I just ran to somebody, this isn't that enticing. But it's only showing and assuming a 4% dividend rate, which in all reality should not happen because interest rates, as we've seen, have already started to go up. So the interest or the dividend is gonna be higher, should be higher than what they're illustrating.
The 10-year average for the S&P, it's 10.8, right?
Is 10, I don't know the
I mean,
exact.
it's actually probably higher. Is that the number? Anyway, I was just asking why can they only illustrate 5.65 if that's the average?
All the companies have 10.7 on average since 1957. The index has done slightly better than that in the past decade, is 14.7%.
Over the
So in
past
the
10
last
years?
of the past 10 is
So
14.7.
why can they only illustrate 5.65?
Based on how they file with the states, they file.
Cause FINRA says so.
Is that?
That's probably to the end.
Cause FINRA says so.
Probably to the end of 2021.
Imagine if we could,
I have it at about 11%
Right.
year to date.
just imagine if we could illustrate the actual average, 14%, it looks so crazy.
Well, that's where you use your sales process.
Then it doesn't
Yeah,
perform.
I know.
By showing the historical
I
and
know.
saying, and remember, I'm only showing you
I do that.
5.6%.
I do that every time, yeah.
Where you guys, again, are doing this, whether it's IUL, 10-pay, IWL, whatever it is, if they're looking at it as an asset class for college, for retirement, I keep saying it, is you wanna show it income. And the way I always show it is I compare it in the chart to time value of money, right? You guys have seen me do that, I think a bunch of times. You're showing objectivity, and it's just pure math. And really what that person ends up doing, for many of the conversations I had, is they end up doing both, right? They continue to do the 401k, the IRA contributions, and they'll peel off some money into the IUL or the whole life.
And a lot of times people are overfunding their retirement to get the maximum match.
Right.
So there's money available there.
But people can peel money off, like if they're contributing, we talked about it, to deferred comp into, in their public employee. Not only do they have a pension, but if they have a deferred comp plan, right? A deferred comp plan is basically a non-matching 401k. And most of those individuals are very conservative, meaning they don't want to risk their money in the market. So if they wanted to put some of it into an IUL, does it make sense? Yeah, I mean, possibly. And a lot of them, those public employees, are contributing per pay period several $100s, and they're paid twice per month. So if somebody's doing $300-400 a pay period, they're saving $600 to $800 a month. A lot of them do that. A lot of them do that. So all you're looking at that is you're finding money and you're redirecting where it's going. You're not telling them, here's another bill, here's more money to spend and less money for you to keep. It's just redirecting where you're spending and where you're investing. So if you could find the money for people, and you could find where they can reposition and why it repositions, it makes it,
More enticing.
and it makes it simpler. It makes it simpler for them to make those types of decisions. We've talked about, keep an eye out for people that have VULs or variable annuities, but VUL specifically to life insurance, is that they've lost, the market's has been down over the last 10 months, 9 months, what have you. They can 1035 that money into a IUL or a whole life if they're insurable to, and maybe not have to pay premiums ever again. Frank had that nice case that we illustrated a few weeks ago. Francisco's doing one as we speak, as of last week. But you gotta be able, and when he did it, he called the guy, this physician, for a long time. And finally, we got him on the phone and we're like, look, this is what's going on. He goes, okay, let's do it let's speak next Monday. This was 2 Fridays ago. And last Monday, we explained to him, you have a VUL, there's $375,000 of insurance, you've got $200,000 last time we spoke of cash. He said, no, it's now down to $175. He's paying $300 a month for the policy, and he's been paying $300 a month. We showed him if he puts the $175 in from 1035 cash value from his Phoenix Life policy to the IUL, specifically with Ohio, what would it do? And he doesn't have to pay premium ever again. Or if he wants to pay the same $300 for 10 years until he retires, he could. So we gave him all options. Move the 175 over and pay nothing. Move the 175 over and pay 150 a month. Move the 175 over and pay 300 a month. But to keep what you have, you only have 375,000 of insurance. We're getting you 650 without having to pay a dime anymore. And you've lost money, and you can continue to lose money or make money. But in our, what we're showing you, you can never lose money based on market decline. He's like, why wouldn't I do it?
Exactly.
And the only time you wouldn't do it is if he was not insurable. That's the only time in that particular case that he would do that. Questions? No?